Moving averages serve as essential tools for determining both long-term and short-term market trends. Different timeframes, such as 20, 50, 100, and 200 periods, fulfill specific analytical purposes, each contributing uniquely to market analysis. The primary functions of moving averages encompass trend identification, detection of trend changes, and the recognition of support and resistance zones within the market. Through their various applications, moving averages provide a comprehensive framework for understanding market dynamics. By analyzing the relationship between price and the moving average, traders gain valuable insights into prevailing market trends, indicating whether the price is in an uptrend or downtrend. This relationship is fundamental in shaping trading strategies. When prices ascend above the moving average, it signals an uptrend, prompting traders to seek potential buying opportunities. Such conditions represent ideal scenarios for capitalizing on market gains. Conversely, when prices persist below the moving average, it denotes a downtrend. In this context, traders are advised to pursue selling opportunities, thereby minimizing potential losses during bearish market conditions. In range-bound market scenarios, price fluctuations around the moving average complicate trend identification. During such periods, it is prudent for traders to exercise patience and await clearer trends before executing trades. A sideways trend reflects price stability, which advises traders to refrain from entering sell trades at the upper range. This strategic approach aligns with the overarching long-term uptrend. The slope of moving averages offers critical insights into trend strength, enabling traders to calibrate their strategies toward more aggressive or cautious entry points based on market conditions. Employing multiple moving averages, such as the 50 and 200 period MAs, provides clarity regarding market trends by illustrating the relative positions of these averages on a chart. This multifaceted approach enhances overall trend analysis. In an established uptrend, the smaller moving average typically resides above the larger one, indicating a favorable environment for identifying buying opportunities. Traders should be vigilant in recognizing this pattern to capitalize on profit potential. Trend reversals can be detected through price crossovers. A crossover occurring from above to below the moving average signifies a bearish reversal, assisting traders in determining optimal selling points. To mitigate the occurrence of false signals, traders may implement a moving average crossover strategy involving different period settings. This method enhances trend confirmation and aids in effective decision-making. Bullish reversals are indicated when a smaller moving average crosses above a larger one, suggesting a potential increase in price. This development serves as a critical indicator for traders to monitor closely. Additionally, moving averages function as dynamic support and resistance levels, adapting to price fluctuations over time. This adaptability equips traders with improved mechanisms for identifying optimal entry and exit points. In the context of an uptrend, prices frequently remain above the moving average, thereby providing lucrative buying opportunities. Conversely, during a downtrend, prices generally stay below the moving average, pointing toward viable selling opportunities.